Hello. In this video, we'll be going through basic earnings per share. Earnings per share is a number that is used widely by investors and creditors alike, and it's a way of summarizing the performance of a business into a single number. And every corporation issues its earnings per share because investors are so interested in it. And it makes comparability between companies really difficult because there's so many different things that go into it. So the FASB has issued many rules as to how to calculate earnings per share so that we can maximize the comparability of it and therefore minimize the inconsistencies of how companies each calculate their earnings per share. So we're going to go into basic earnings per share in this video, but as we'll continue in other videos going into dilutive earnings per share, you'll see how many rules there are around it, and this is why. It's so that it can be comparative from one business to another. There's two types of capital structures. There's a simple capital structure, and when a corporation has a simple capital structure, it means that it basically only has common shares outstandings and no other sort of shares or securities that could potentially dilute or reduce their earnings per share. A complex capital structure is exactly the opposite. It does have dilutive securities outstanding. And when we say dilutive, it means there are securities out there that are not common shares yet, but have the potential to be common shares. So for instance, if a company issues stock options, that has the potential to convert into common shares when the person who has them decides to exercise them. If there's some preferred shares that can be converted into common shares. You can have convertible bonds, so that can be bonds that are convertible to shares sometime in the future. So if a corporation has any of those types of securities outstanding, then they fall under this complex capital structure. We're going to go with basic earnings per share, and basic earnings per share is really for those simple capital structure kind of corporations. And what earnings per share does, it basically tells the reader of the financial statements is for each share of common stock that I own, how much earnings do I get from that share? So you take your earnings available to the common shareholders. So this is really important. This is only for common shareholders, divided by the weighted average number of common shares outstanding. And we're going to go into how to calculate that. Now, so the EPS, earnings per share, is the numerator is the earnings available to common shareholders, but there's times, and becomes more intricate of a calculation when there's preferred shareholders and they get dividends, right? Because they get their dividends first and it's going to come out of the earnings. It becomes more complicated to calculate earnings per share when the number of shares change during the reporting period, and the reporting period is typically a year for our purposes. And again, there are potential common shares that might participate in future earnings. So there's all kinds of things that can make the whole calculation not as basic as you might expect. Let's go into the fundamental calculation of earnings per share, and we're going to use this one example and build on it. Silverand Financial Corporation reported net income, okay, so this is net, of $154 million in 2027. Its capital structure consists of the following. Common stock, it has 60, on January 1, it has 60 million common shares outstanding. That's it. This is a simple structure, capital structure. So the basic earnings per share is we're going to take their net income divided by the weighted average number of shares outstanding, which is just 60 million. And our earnings per share is $2.57. So for every share I own, I'm going to there's $2.57 of earnings available. That doesn't mean I'm going to get it as a shareholder. It just means that's what the company has. Now, so here I have this little table that I'm going to continue to build on. On January 1, that was our beginning balance, and the dates outstanding for those shares, those 60 million shares were outstanding, was for the whole year. So let's say that this table is in thousands. I should have put that up here. So all these numbers are in thousands because the examples are millions, but I didn't want to put so many zeros on this table. So I'm just going to say 1,000, but it's the same. You'll get the gist of the calculation. So we have 60,000 shares outstanding, okay, at the beginning of the year. And so that means they're outstanding the entire year. So we have 60,000. That's what we just went through. On March 1st, the company issued 12,000 shares for cash. They sold common shares for cash. Okay, so that means that those 12,000 shares were outstanding, right? They're out in the open market from March 1 to December 31. So what we're going to do is we're going to take those number of shares, those shares outstanding of 12,000, and multiply it by the fraction of the year that they were outstanding, which is 10 months out of the 12 months, right? Because we only issued them from March 1 to December 31 is 10 months. And so then we get 10,000. So now, if we include this issuance of 12,000 shares, our weighted average number of shares outstanding is 70,000. And that's what we're going to use to calculate our earnings per share. So when we look at earnings per share, right here, this big arrow, I have my 154, that was not good, my $154 million of net income divided by 70 million of shares outstanding gives me basic earnings per share of $2.20. Now, what happens when a company issues stock dividends or stock splits? Okay, when stock dividends happen or stock splits happen, it means that there's going to be additional shares that are being distributed to the existing shareholders. Now, the change in the nature of the shares is reflected in the calculation of EPS by increasing the number of shares. So if we are issuing, right, we're distributing additional shares, then our EPS is going to change because our numerator includes the common shares, the number of shares outstanding. So it's going to increase. Let's quickly do a side-by-side comparison when we increase our shares by selling new shares versus increasing the shares by distributing stock dividends or having a stock split. When we increase shares by selling them, then the shareholders' equity is increased by an additional investment in the firm by shareholders. So basically, when we sell shares, we increase our assets because debit, presumably cash, and we increase our equity because we're going to credit the common stock and the paid-in capital in excess of par. Okay, so when we sell new shares, the existing shareholders' interest in the company's earnings is diluted, right? Because now there's more shares out there to split the same amount of earnings. So the existing shareholders, their interest in the company is diluted. Alternatively, when we increase shares caused by a stock dividend or a stock split, yes, the number of shares are increased, but it doesn't dilute the existing shareholders' interests. It's just a larger number with less valuable shares. So you have the same pie, more slices. So think of a slice of pizza with 8 slices, and then we can cut those pizza. So if we have 8 shareholders and they each get 1 slice, versus if we have the same size pizza and we cut into 16 slices and each of those 8 people now get 2 slices, they still have the same amount. So when we issue a stock dividend, we don't need to prorata it by the fraction of the year that is outstanding, because because all of the shares that are outstanding up to that point get increased for the entire time. So let's say June, and we'll go through, I'll show you how that works. But On June 17th, the company issued a 10% stock dividend. So we're going to keep building on our example. So we left off that the average number of weighted shares outstanding was 70,000. Now we've issued a 10% stock dividend to the existing shareholders. So we've now issued an additional 7,000 shares, right? 70,000 times 10%. So now our weighted average number of shares outstanding is 77,000 or 77 million. Let's go to our EPS calculation now. Again, our EPS calculation, earnings per share, is the amount of earnings available to common shareholders, which we're told is 154 million. And now our average number of weighted shares outstanding is 77 million. So now our earnings per share is $2 per share. I want to go through just a really quick visual. Let's say here I have a pre-stock dividend, and here's my post-stock dividend, right? Let's say you're the shareholder and you have here the number of shares. You have 100 shares. And pre-stock dividend, what was our earnings per share? Let's go back. Here, this is before we had that stock dividend. Our earnings per share was $2.20. So here, our earnings per share, it was $2.20. So our interest in earnings as a shareholder was worth $220. Now let's look at post-stock dividend. In the shares, we had 100 shares, but then there was a 10% stock dividend. So now we have 110 shares, and the earnings per share after the stock dividend was $2. Sorry, it was $2 right here. This is after the 10% stock dividend was just distributed. So now times 2, I still have my interest in the earnings is still $220. So the stock dividend, even though it dilutes the number of common shares, it still does it dilutes the number of common shares. So it makes the denominator bigger. But at the same time, as a shareholder, the number of shares that you own is also larger. So it doesn't make an impact to the EPS for purposes of your earnings of your share in those earnings. Now let's talk about reacquired shares. We've learned in the previous chapter about when corporations sometimes will buy back their own shares, and they'll either just hold it as treasury stock because they plan to resell at some point, or they might actually retire them. But when we buy back shares of either one as treasury stock or retired, then those shares are no longer outstanding. And the EPS number is the denominator is the average number weighted of shares of common shares outstanding. So when we reacquire shares, right, when we buy back our share, we have to weigh it for the fraction of the year that they were not outstanding. So let's go back to here, our chart. So on October 1, let's just say we had 8 million shares were reacquired, let's say 8,000 shares were reacquired as treasury stock. Okay, so that means that those shares were no longer outstanding from October 1 to December 31, which is 3 months. So under this column that says shares outstanding right here, I'm going to have a negative number because now I'm removing it from the shares outstanding because I'm reacquiring them. And they were no longer outstanding only for the last 3 months of the year, 3 out of 12. So I'm going to reduce this by 2 because 8,000 times 0.25 is what 312 says is 2,000. So now I had 77,000 weighted shares, common shares, and now I'm reducing it by 2. So my weighted average number of shares outstanding now is 75,000. So when I do my earnings per share, I'm going to circle it right here. I take my net income of 154 million divided by my weighted average common shares outstanding of 75,000, and my new earnings per share is $2.05. Let's do a concept check. On December 31, 2026, Wayne Sparks Company had 600,000 shares of common stock issued and outstanding. Okay, so it's very important when we're looking at the outstanding shares. Sparks issued a 5% stock dividend on June 30th, 2027. On September 30th, 2027, 20,000 shares of common stock were reacquired as treasury stock. What is the appropriate number of shares to be used in the basic earnings per share computation for 2027? Well, let's look at our beginning balance. On January 1, we had 600,000 shares. Okay, that's our starting point. Then on June 30th, we're told there was a 5% stock dividend. So we've now issued 30,000 new shares because we took the 600,000 times 5% is an additional 30,000. So now we have 630,000 weighted shares. And then we're going to look at September 30th. 20,000 shares were reacquired as treasury stock. So the dates outstanding, this says September 30th. I changed it to October 1st. Same difference for purposes of the class and the CPA exam. But it's going to be 3 months out of the year. We're going to reduce our number of shares outstanding because they're no longer outstanding for the last 3 months of the year. So I'm going to remove 5,000. So my weighted average number of shares outstanding for 2027 will be 625,000 shares. Now, earnings per share, the numerator we said is earnings available to common shareholders. So the key here is the earnings that are available to common shareholders. Now, we all know that dividends are paid out of the earnings, out of the company's retained earnings, right? Out of earnings. So when we're looking at the earnings available to common shareholders, if a corporation has preferred shareholders that own cumulative preferred stock. Now, what is cumulative preferred stock? Cumulative preferred stock is when even if dividends are not declared in the current period, they are owed the dividends on a rolling basis, so it'll be accumulated. So the presumption being that the dividends will eventually be paid out. So if a company has cumulative preferred stock shareholders, we have to, from the earnings available to common shareholders, we have to remove some of those earnings or the dividend amount from that numerator number, because this numerator is only available to common shareholders for earnings per share calculations. So here we have the same Sovran Financial Corporation, and it's had all these things going on over the year that we've already been through. But now we're told that they also have preferred stock non-convertible shares outstanding. So non-convertible means that these particular preferred stock are not convertible into common stock. So we don't have to deal with that issue here. But they're outstanding for the full year. They had 5 million shares at 8%, 5 million shares, $10 par. So we first have to calculate what that preferred dividend is. Whether it's paid or not doesn't really matter, because we have to remove it from our numerator, our earnings, because this net income of 154 has to be reduced by the preferred dividend amount. And so the preferred dividend, the way we calculate it is we take the number of shares, the 5 million, times the 8% times $10 par, and we get $4 million. So we're going to take on the numerator now is going to be 154 million minus 4 million for the preferred dividends. So then our earnings, our numerator is equal to earnings for common shareholders. So $150 million divided by 75, which is still our average number of weighted common shares outstanding. So our EPS, our earnings per share, is $2. Let's do a concept check. On December 31, 2027 and 2028, Hathcock Company had outstanding 50 million common shares and 4 million shares of 10%, $10 par cumulative preferred stock. Net income for 2028 was $20 million. No dividends were declared in 2028. What is the earnings per share for 2028? Well, first, because this is a cumulative preferred stock, we have to calculate the dividend on that preferred stock and subtract it out of our net income number. So we're told our net income number was 20 million. So we have to, so just that was just kind of a side note. Just know that we're going to subtract those dividends. But first, let's just deal with the very, very basics. We're going to take our net income divided by our common shares outstanding, and these were just outstanding for the full year, 50 million, and we had no other activity. But now we have to calculate our preferred stock dividend, which is going to be the 10% times $10 par times 4 million shares of preferred stock. Okay, don't get that confused with the 50 million, because the 50 million is only for common stock. So that makes preferred dividend was equal to 4 million. So this is equals 4 million. And so now our numerator is 16 million, denominator is 50 million. So this EPS is 32 cents per share.